Good afternoon, everyone. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is June 1st, 2023, and we're going to ask the question, is the Fed afraid to raise rates? Over the last year or so, with the Federal Reserve, they've been very clear that saying we need to and we are committed to getting control of inflation. They've said they would use all the tools in their arsenal to control inflation and bring it down, to get to that rate of 2% growth and 3% inflation. Well, they've started to move the goalposts already. They've already started talking about the idea that maybe we need to make some adjustments to what our target rate is. Maybe we need to adjust to what we expect, justifying the fact that they're struggling getting inflation in check. Yet you would think that if they're struggling with inflation, that they would continue to raise rates to get inflation in check, to stop the demand, to reverse the demand in the markets. But over the last couple of days, we've seen data and comments that would suggest otherwise. Starting out with comments from Fed Harker. President Patrick Harker is from the Philadelphia Federal Reserve Bank, and he said on yesterday, the U.S. economy is incredibly resilient, and added that their model forecasts no recession ahead. According to him, the unemployment rate is going to tick up towards 4.4%, and so it would seem to me that that is the justification to continue to raise rates. If the economy is so resilient, if we're going to see a less than 5% unemployment rate, which is considered fully employed, then why are we not going to continue to raise rates? He also commented that regarding the interest rates, that he favored pausing at the next meeting. He warned that incoming data may change his mind. He already has the data. The Federal Reserve and the Federal Reserve presidents already have the data that's being released this week. This week we've seen unemployment data, we've seen ADP data, we've seen jobs opening labor turnover surveys. We already know the information that's in the market. And so what data is he going to get? In fact, he was trying so hard to not say that we were going to pause that he said maybe we can just skip a meeting, which is unheard of. The idea that, well, we're going to skip a meeting, which means that we're not going to raise rates, but that's not really a pause, but it is a pause because we're not going to raise rates, but we're just going to skip a meeting. It's complete double talk and a view of we're just telling you that we're not going to raise rates, but we don't want to say that we're not going to raise rates because we need to raise rates because inflation is still high. Let's look at the data. Number one, is inflation still high? We're going to go right into the source for bls.gov. This is the CPI data. You can see that the CPI data is still positive and growing. This is a month-to-month image. And so when we're seeing these rise, anything above zero means that we're higher than we were last month. Any bullish trend means that we're higher over last month and over last year. We can see that the numbers have been positive. We have seen continual increase of inflation starting from June of 2020. Every single month except for these two Novembers, which is to be expected. Except for those two, we've had higher inflation, increasing costs every single month over those last 2 years now. In fact, we're now going into the third year with only the November showing a negative 0.1%. If we look at the data, according to the BLS, year over year, we're now at about 4.93%. So we're still well over the year-over-year inflation numbers that we're targeting, the inflation rate that we want to make sure we can control. And flat inflation, zeros and zeros, 0.1s, negative 0.1s, when we're seeing inflation not grow over month, doesn't mean that we've reversed inflation. Does not mean there's been disinflation. So imagine, if you would, we'll use a car's price. Let's say a car costs $30,000 and inflation causes that car to go up to $35,000, $40,000. So from $30,000 to $40,000, you've seen 33% increased cost or inflation for that car. If the car stays at $40,000 for the next year, you would show 0% inflation on that car. You'd say 0% inflation year over year. And then if they discounted it by, say, $2,000, well, now you're talking about a 0.5% disinflation or deflation, when reality is you're still selling that car for $38,000, well above what it was just 2 years prior. And so inflation not climbing will show up as no inflation. And reality is it's not. It's still holding at those higher prices. So as long as we keep these numbers high, we're still seeing inflation. Inflation is still remaining high, and even though it's running at 4.9%, it's 4.9% after running 10% from a year ago last year. And if we look at month over month, We're up 0.4% for last month, and you'll see the only reason why we're not up a lot more is because energy prices were down. Well, what did we see? Energy prices were down negative 5%, but you can see all items were up 5%. That includes energy weighing it down. Food prices are up 7%. The core, or net food minus, or net CPI minus food and energy, is up 5.5. So we're seeing 5.5% inflation last month. 5.5, well above what we're already talking about. So we're seeing 5.5%. 5.5% is well above their target, and we're still seeing growth. If energy prices, what kept that from being much higher, we're at 5.5%. If energy prices were higher, how much higher would inflation be? Do we need to be concerned about that? Is inflation going to run hot next month? If we look at crude prices, you can see that correction for April. We can see a huge sell-off in energy prices. Crude prices were down from $82, $83 all the way down to $63 at one point. But as of today, we've bounced and rallied 3%. So if May ends up getting higher than its May's open, here's May's open. Let's just kind of come back to that open price. If we get back above 75, then that negative or that deflationary, the disinflation in crude will not keep inflation from running higher. We will see inflation run extremely hot. So again, why is the Fed not talking about raising rates? Why are we talking about skipping a meeting or doing a temporary pause, which I don't understand the difference between a pause versus a temporary pause. But as we're looking at this, we take a look at the Fed funds futures and the interest rates. If we look at the ZQ from April, we can see that prices were trading about 94.93. It dropped down to trade to about 94.83. So that is 10 basis points being priced in of a rate hike, which is about 40% higher likelihood of a rate hike going into just 2 days ago. As soon as Fed President Harker spoke, saying that we maybe do a pause, we erased about half of that. We erased about half the probabilities that were being priced in from April to June. And so we're watching the change in that shift, and that change in that shift has definitely moved us further away, but it's a lot more dramatic when we saw the CME's FedWatch tool. The CME's FedWatch tool went from a 71% probability of a rate hike to a 23% probability of rate hike in just 2 days. We've erased almost a guarantee, a lock of a rate hike in June to say, no, we're going to pause. All off of comments. Now, President Harker is a voting member, so that is a bigger indication than when maybe one of the other Fed members that don't have voting rights, when they are making comments. But it does feel like the market is rallying off of the Fed comments. It does appear that the Federal Reserve is afraid to be the ones that slow the economy or slow the equity market, which is oftentimes viewed as a representation of the economy. Reality is, they've continually said this for 2 years, that we need to slow demand and slow the economy to get the interest rates under control. And yet here we are going from a 70% probability to a 50% to a 23% probability of that rate hike. And a 5.25% to 5.5% rate hike or value is not really high. It is relatively low for U.S. history. It's just relatively high over the last few years. Looking at the dollar index, we can really start to see the demand for the dollar versus the euro, well, against a basket of currencies. So the dollar index is a basket of currencies, but about 55% of it's the dollar versus the euro. So when this is rising, it's the dollar gaining, the euro losing, and the dollar gaining versus the other remaining currencies that are making up less than 45% combined. But as we're watching this, all of these moves, we've talked about this before, all of these moves have been in the overnight price action. Almost every single candle has had a non-existent body, which means it's overnight price action that's driven the dollar higher and higher and higher. This bet, despite the fact that inflation is still there, despite the fact that the European inflation is slowing, these bets, these moves are all being driven off of the idea and the concept of what interest rates are you going to give me? The comparison is stronger in comparing interest rates offered on deposits, as reserve currencies will have higher demand for higher interest rates than they are on inflation. So let's see what happened after Harker spoke. We spike up here, we trade up a little bit higher during the overnight, we trade down slightly, the dollar weakens slightly after Fed's Harker speaks, and then in the overnight, the US dollar gets obliterated. We gap down and drop all the way down nearly 1.5 points. As we're watching that pullback, we're going to see it even more dramatically in the spike higher in the euro. If the US is not going to offer higher interest rates, then the demand for the euro is equal or greater if the US is not raising rates anymore. With the euro US dollar, you can see the euro US dollar is currently up 0.63%. I've shown this before. Generally speaking, if you take this number 0.63% up for the euro or a negative 0.63% move in the dollar, you can take the inverse of the dollar or the positive correlation with the euro US dollar to equities and take this by a multiple about 2.5 times. So if we're looking at the euro US dollar being up 0.6%, then we would expect to see 2 times to 2.5 times move higher in the S&P 500. Go back to the S&P 500 and we can see we're up currently 0.76%, but just a few minutes ago we were up from the open about 1.22%. So almost exactly 2 times the move down in the dollar or the move up in the euro. So the market's still behaving almost exclusively off of this money, the Fed money, and how expensive the Fed money and borrowing is going to be. If money is going to remain cheap, equities are going to push higher. If we're not going to raise rates, equities are going to push higher. If we're going to pause and possibly then start cutting by fall, equities are going to push higher. And it appears again that the Fed is afraid of raising rates and stopping equities from moving higher. We're near the 9-month high. Why are we afraid of seeing a pullback? Why are we afraid of an adjustment when we also claim that that is what's needed to stop inflation? And if we weren't really worried about inflation, then we wouldn't expect to see crude prices up 2.85%, which was over 3-4% earlier today. We wouldn't expect to see copper prices climbing today by nearly 2%, well off the lows, 354 up to 370. If we weren't expecting to see higher inflation. If we're going to see a weaker dollar, if we're going to not raise rates, if we're not going to combat inflation, then all the things that are subject to inflation, specifically commodities, and including homes and equities, all of these are subject to that inflation or the fact that the dollar is going to buy less of these. We should expect to see equities rise. We should expect to see commodity prices rise if we're not going to combat inflation anymore. And as we can see, we've gone from a 3.86% 10-year Treasury rate all the way down today to 3.6, back up to, right around 3.6. And this pullback is almost a 0.25% cut in interest rates. This does not fix our inverted yield curve. It just means that all the yields, all the interest rates are sliding and adjusting back that 25 basis points that we're probably not going to get in June now. The danger here is that the ZN is rising. Bond prices are going up. The ZN, ZF, ZB, all the bond prices are going up. And we're climbing up right before, prices are going higher, right before we see another $1 trillion of treasuries issued into the market. When that next layer of treasuries come into the market, unless they're going to be bought up aggressively, then these prices are likely to fall. And if they do fall, we will see higher interest rates. Whether the Fed wants to pause or not, we're going to see higher interest rates and we will see an increased cost to borrow. Now, I think some of the catalysts that we can use or the indicators that we can use are simple price. If you see crude go back above key levels, specifically, I would say about 74. If crude goes above 74, we're probably going to see a move from about 66 to 74 repeated, which means we will see prices get back up into these previous highs. A move back up to 82 will mean that inflation is going to increase and energy is going to increase in cost by upwards of 10 to 15% if crude breaks through that high. A move higher in crude by 10 to 15% when production has been cut and slashed by OPEC, that is a very high likelihood event. If energy prices go higher, inflation will come back with a fury. And because it doesn't tie to just energy, it ties to everything that energy does, including transportation. if we see that happen. Additionally, watch for gold and copper. If we start seeing hedging there because the Fed is not going to be raising rates, watch for copper to break through about 370, 380 and get back up to about 410. That move there would be another 10% move in copper. If we're seeing 10% moves in inflationary products like copper and oil, and we'll use gold ETF here for this next one, we're already out of balance area for GLD, but we will likely see an inflation hedge here as well and push back up to 189 to 190. That's only about a 5% move, but it's going to be that hedge that is going to be confirming what we're already seeing. So as long as the Fed's not going to do what it's talked about, as long as the Fed's not going to raise rates, we should expect equities to move higher, gold to move higher, copper to move higher, and oil to move higher. But if they go higher than 10%, then you will start seeing the market panic and price in hyperinflation. These are the key levels to watch for. The Fed's afraid to act. The Fed's afraid to be the one that drives the market into recession, to get blamed for driving into recession because they raised rates too far. And we've seen too many hints and comments from other Fed members saying that they don't want to raise rates too far, that would be dangerous. But we also know that the bigger danger is in hyperinflation if they can't keep inflation in check. So even though I don't think we're done here, I don't think we've seen the top of the market, I also don't think we're going to see record highs again in equities. I don't think we will see equities go back above even the year's highs if we're going to see inflation remain high in gold, silver, copper, oil, and the other core commodities. But if the Fed's not willing to act, that's what we can expect. Now, all of those levels that I just talked about are also potential breakouts and trades. If you see gold break through 184, 185, then you have a $5 move potentially to the upside. Same thing with crude. If you break through 74, you might have a $7, $8 move up to the upside as a trade. And we can trade higher cost and higher inflation, especially if the Fed's not going to raise rates. Some things to look at over the next couple of weeks as we get closer to this Fed meeting and as we watch more data come in, especially employment data we'll see tomorrow, and we'll see that we are still strong employment-wise, likely justifying even more rate hikes, but the market is still pricing in Fed Harker's comments. Have a great day, everybody. We'll talk to you again next week.